Hello and welcome from Trend Signal for a review of the data and events the week beginning the 26th of October. British winter time has kicked in, so there's a week difference with the US while we wait for their daylight savings to kick in this coming weekend, which basically means there's now a 4-hour difference between the UK, Eurozone as well, and the US, which basically means their markets open an hour earlier. So instead of 2:30 for the New York Stock Exchange, it's 1:30, and all data that normally comes out at 1:30 obviously is 12:30. Just for 1 week, it all changes back to a 5-hour difference when the US do their daylight savings next weekend. So I'm sure everyone realizes what has happened over the last couple of days with the ECB action last Thursday, causing a significant reaction in equity, bond, foreign exchange markets. I think markets were expecting a little bit of comment on QE, but nothing like as aggressive as was mentioned by Mario Draghi, Super Mario, as he's described by in some quarters. Basically, the news is there's going to be a review of the QE program in December, meeting when expectations for an extension of the existing QE program that was due to expire 2016. The duration and the size could well be altered, and also a cut in the deposit rate from -0.2 to -0.4%. And if that wasn't enough, on China, the in China, the People's Bank of China on Friday, that is, cut the official bank rate by 0.25% to 4.35%. And just to underline how the Chinese economy has been slowing, that is the 6th cut in 12 months. So most of the movements that we saw last week, some significant moves in equities, really all happened on Thursday afternoon and Friday. For example, the DAX ended up rallying 734 points on the week last week, which is a shade over 7%, so it's a significant move. The CAC, not quite as much, that rallied 225 points, just 5%, but a significant move nevertheless. Bond markets, not too much of a move in the sort of core bonds, but the likes of the BTP, the Italian bond, that rallied 550 points or 2%, whereas the likes of the Bund and the Gilt, actually, that fell. Yields actually rallied or hardened a little bit. It should be noted that the yield on all Eurozone 2-year bonds have been falling in negative territory. In fact, every single bond now is in negative territory, whilst the yield on the German 2-year hit a record, a negative -0.32%. So a sign of what the markets are expecting from the ECB, really. A significant rally in the US dollar last week as well on the back of that, or a significant fall in the euro, I'd say, although the dollar also rallied across the board, really. 336 points on the euro, that's 3%. That's a significant move in the euro, and it seems that we're sort of resuming the sort of path or action that the euro was engaged in sort of December through to mid-March this year. We expect to see a resumption in that sort of weakness in the euro as a threat of further QE and a cut in the deposit rate puts that euro under further pressure. Equities obviously rally on the back of it. A weaker euro is very positive for the Eurozone exporters, making all the goods and services that much cheaper in their target markets. So possibly more of that to come as well, I suspect. Data this week, let's have a look at the calendar. It's an important week, hot on the heels of the Chinese rate cut and obviously the news from the ECB last Thursday. We've got the Federal Open Market Committee meeting. That's the rate setting committee of the Federal Reserve, the central bank of the US. They meet again for a 2-day meeting culminating on Wednesday when, ironically, we're probably not expecting anything now, certainly in light of the move by the Chinese and the ECB. The dollar has strengthened considerably, which is effectively a sort of monetary tightening. So I think they're very, very unlikely now to raise rates this particular month anyway. We do have GDP data out as well, although it's after the meeting. It comes out on Thursday. This is one of 3 readings of the gross domestic product for the United States. Recent data has been particularly poor. That number, 1.6%, does reflect that. the FOMC will have sight of this. They will know what the GDP data is, unless it is a startlingly strong number, which I think it's unlikely to be. I think that's another reason why the Fed will stay pat on rates, certainly for this month and likely November as well. In the UK, we have our first reading of Q3 GDP, reasonably good number. Data has been improving here in the UK, plus 0.6%. Is the number that we're expecting there. We've already had a data release in Germany, the IFO business climate sentiment affected by the Volkswagen emissions scandal. It's very much out of date already, that now, bearing in mind what's happened with the ECB. Sentiment will have improved significantly since last Thursday, so I think the markets will largely ignore that particular number. Other than that, this week, we've also got the Reserve Bank of New Zealand meeting. There's talk about another quarter-point cut, but consensus is for no cut. At least that's what the view is for the time being. We also have the Bank of Japan meeting on Friday, their monthly policy meeting. Recent comments from the Japanese government suggest that the Bank of Japan could stay pat on any QE amendment or any further monetary stimulus. But in light of what's actually happened with China and the ECB, I think it's possible that we could see something announced this month. So that comes out early Friday morning, so we'll know the results of that when we get in on Friday, certainly with respect to the Nikkei and the Japanese yen. That's it for all the data releases this week. Thank you very much for listening. Bye for now.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.